Welcome back. Consumer inflation in South Africa has continued on its upward trajectory, reaching a 13-year high of 7.4% in June from 6.5% in May. The main drivers were food and fuel and housing and utilities. Inflation is way above the Reserve Bank's targeted bracket of 3 to 6% for the second consecutive month. Old Mutual Investment Group Chief Economist Johann Els is joining us to talk about this. A very good evening to you, Mr. Els. I think before we get to the actual figures, Johann, I want to just look at a theory, and I'd like to hear your thoughts that the drastic increases and failing to reach what would be a desirable average often points to political and economic turmoil. And just looking at South Africa today, the recent events, is this something that you'd agree with?
Yeah, it is something that impacts significantly in terms of confidence levels. So consumers, businesses, and investors, especially foreign investors, they look at these kind of events, and that is hugely important then in terms of what they perceive the policy and political environment and the impact that have on economic growth. It doesn't really have a direct impact in terms of prices or inflation or price trends, but it's hugely important in the case of South Africa, which is a small, very small, and a very open economy. So perceptions around these things are hugely important always.
And I'm just looking at a comparison of the energy and food prices over the years. I mean, I think it was between 2008 and 2009 that we saw fuel prices spike. But in terms of food inflation, the years between 2013 and 2014, we saw that at the highest. And now we have a confluence of both. In comparison to what the inflation rate is globally, where are we on the scale of things?
Yeah, fortunately, our problem in South Africa regarding inflation, yes, it is a problem, but it's not the same severity as we see in developed economies like the USA or Euro area or the UK, for instance. Our inflation is also pushed up by fuel prices, petrol prices, and food, the same as those countries. But then, for example, in the USA, they've had significant stimulus during and after the COVID crisis, which boosted their price level significantly because consumers' spending was strong, and thus the ability of consumers to absorb price increases, but also the supply chain impacts in terms of hotels and airlines and electronics that impacted on cars, etc. We haven't had the same kind of issues. Our economy wasn't stimulated to that extent. So there's very little demand inflation in our economy. But certainly, our inflation numbers also boosted by the war impact that impacted on oil prices and food prices. But the rest, the underlying picture, not as severe, although I do see some signs of other price increases coming through.
Core inflation itself was at its highest in June, according to the figures. And on a monthly basis, consumer prices were also up. Just break it down for us.
Yeah, core inflation, fortunately, is at 4.4%. The Reserve Bank would be relatively happy with that when they start thinking about the interest rate decision, because core inflation at 4.4 is around the midpoint of the target range, where ideally we've had our headline inflation and where we want headline inflation. But masking that is the fact that apart from fuel and food prices, there's some more stronger increases coming through. Firstly, in consumer goods, we've seen appliances inflation, furniture inflation, clothing and footwear, and vehicle inflation numbers lifting quite a bit. And then we've also seen rental inflation, which is a huge part of the CPI basket with a 17% weight. That has started lifting up more rapidly. So whereas there's still a big gap between goods inflation, driven by petrol and food, and services inflation, which is much lower, and that's also a key difference between South Africa and the rest of the world. Services inflation low, but that's starting to drift up. So while I still believe that we're close to a peak in our headline inflation numbers, there's some worrying trends within all these different components within the CPI numbers.
And I'm glad you raised that, because I want to ask on a practical level for us, the consumer. We mentioned utilities. What about CPI and transportation?
I'm sorry, I lost the voice.
Okay, I was saying we mentioned utilities at the onset, and I'm wondering at a practical level, what should be our expectations for us consumers? CPI and transportation, that has gone up for us, for instance, as well.
Yes, so there's quite a few variables here. It looks like, firstly, in terms of transportation, that oil prices have peaked for now, but there's lots of uncertainty, as you know. We don't know what how the war will play out and what the impact on oil prices will be. For now, it seems that oil prices have peaked. So also, it looks like petrol prices are going to decline in August.
Yeah,
there's a huge over-recovery on the daily petrol price. So that should help. It looks like international food prices have been peaking. If you look at international food prices, it looks like the actual levels are coming down. So both of those looks like they're peaking. But of course, we know there's significant risk down the line. If you talk about utilities, of course, Eskom, our biggest worry out there in terms of electricity price increases that we hear talking about. This year's price lift in terms of electricity prices is fortunately in the bag, but the next one for next year might be significant. But having said that, despite all the risks there, it does look like our inflation is likely to peak in July and then starts drifting lower because of the oil price peaking and international food prices peaking.
And read together, the fact that factory output has shrunk lesser than expected and the trade surplus is larger than expected, juxtaposing those two figures, what are the expectations then over the next couple of months?
Yeah, we in a fortunate position in South Africa that, overall commodity prices have been significantly better than what everybody expected. So therefore, the trade surplus, that's helping us significantly in this environment where there's fears of a global recession. And on the one hand, we see slower growth in the US and Euro area, but better growth in China starting to come through. So South Africa is relatively insulated with that respect. So the trade balance, the trade surpluses will likely keep on going. But in terms of what you said about the manufacturing production, mining production, also retail sales, in the second quarter of this year, it looks like the economy will experience negative growth in the second quarter. Now, as you know, these numbers lag significantly. We're already into the third quarter, but we're still awaiting final data for the second quarter. It looks like the second quarter will be negative in terms of GDP growth, but we should then see an uplift again in the third quarter as things start to stabilize again. So the SA economy is actually doing better at this stage of a global cycle. In previous cycles, when the global economy was heading into a recession, we had a trade deficit. We had significant fiscal problems. So all of those are looking better now for the SA economy. So we're somewhat better insulated against these global problems.
Johann, thank you so much for speaking to us, and glad we ended on a positive note. Chief Economist at Old Mutual Investment Group, Johann Els, just breaking down those inflation figures for us. Now,